are going to do well, as we can see here, all gains. So today I just want to go over this article, which goes over dollar cost averaging versus like buying the dip. All right. It's a pretty interesting article that, to be honest, like I don't know who this guy is. I've done some research, so I'm not advising or affiliated with this guy or this blog, but this article was like, whew, it was really interesting because it really made me understand dollar cost averaging as a strategy versus option trading and just selling puts for like passive income. So selling puts for passive income, selling puts on margin and creating even more income and just creating this big snowball effect of puts on margin, selling puts, passive income, and just keeping that ball rolling with dollar cost averaging. And as you can see, like we haven't really had any real losses in the portfolio, and it's just been scaling up pretty quickly here. So let's just kind of go over this article. I'm going to give you my thought process as we read through this article and how I'm implementing this whole strategy. So basically, this strategy talks about dollar cost averaging versus buying the dip perfectly. Okay, so imagine that you're dropped somewhere in history between 1920 and 1979, and you have to invest in the U.S. stock market for the next 40 years. You have two investment strategies to choose from. All right, so you can choose from dollar cost averaging, which is investing $100 in every month for all 40 years. Right, so all 40 years, which is quite a long time. Right. In option trading, I've retired in like less than 10 years. I think it took me 8, 9 years. So I mean, you don't need 40 years, but just for example's sake, let's use the 40 that we're using in this article versus buying the dip. So a lot of people always ask me, like, Henry, should I wait to buy a stock or should I wait for a pullback? And I always tell them, don't wait. Okay. It goes into dollar cost averaging is better, but we'll see. We'll go over multiple examples. So buying the dip. So let's say you save $100 each month and you only buy when the market is in a dip. So a dip is defined here as any time when the market is not at an all-time high. Okay. But he says that I'm going to make the second strategy even better. Not only will you buy the dip, but I'm going to make you omniscient, which is like you're like God. You can basically buy like anytime, and you will know exactly when the market is at the absolute bottom between any two all-time highs. So between all-time highs, if it's at a bottom, you will buy it. It's like perfect timing. You have like the best timing in the world. Okay. So the only rule in this game is that you cannot move in and out of the stocks. Once you make a purchase, you hold those stocks until the end of the time period. So which strategy would you choose? Dollar cost averaging or buy the dip? All right. Logically, it seems like buy the dip can't lose. If you're going to be buying like the lowest price possible between two all-time highs, then yeah, like you're gonna crush it, right? Or it seems that way. If you know when you are at a bottom, you can always buy at the cheapest price relative to the all-time highs in that period. However, if you actually run this strategy, you will see that buy the dip underperforms dollar cost averaging over 70% of the time. All right. So this is true despite the fact that you know exactly when the market will hit a bottom. Even God couldn't beat dollar cost averaging. All right. So why is this true? Because buying the dip only works, and there's going to be some examples right here. So we're going to go over some examples shortly. All right. There's some actually really, really cool charts, really, really cool ones. So this is the type of stuff that I was dreaming about doing when I was studying finance in college. I was dreaming about doing this type of research work. So why is this true? Because buying the dip only works when you know that a severe decline is coming and you can time it perfectly. Since dips, especially big ones, haven't happened too often in the US market history, 1930s, 70s, 2000s, this strategy rarely beats our cost averaging. A lot of people are like, I'm going to wait for a pullback or the market's really high. It really doesn't matter most of the time. You'll see why in a second. So the times where it does beat dollar cost averaging requires impeccable timing. Missing the bottom by just 2 months lowers the chance of outperforming dollar cost averaging from 30% to 3%. Instead of taking my word for it, let's dig into the details. All right. So to start, let's consider the US stock market from January 1995 to December 2018, which is a more normal period. That's like more recent, right? We're not talking about 1920. We're talking about more recent. All right. So to familiarize ourselves with the strategy, below I have plotted the S&P 500 with dividends and adjusted for inflation over this time period with all-time highs colored green. Okay. So there's obviously many all-time highs because the market continues to go up. So from the period of 1995 to 2018, just many all-time highs, right? We're just going higher and higher and higher. And then actually for a long time, there wasn't an all-time high. So there's quite some time here actually from 2000 to roughly maybe it was like 2014. So this was probably one of the longest period where it didn't make an all-time high. Mind you, this is inflation adjusted, he says. This is inflation adjusted. So like actually getting your money back, not inflation adjusted, would have happened a lot sooner. All right. So because he's using the Case-Shiller, he's using like Shiller real returns. Okay. These are real returns, meaning again, accounting for inflation. Now I'm going to show you the exact same plot as above, but I'm going to add a red dot for every dip in the market. The biggest decline between a pair of all-time highs. Okay. These dips are at the point at which the buy the dip strategy would make a purchase. So between some all-time highs, there has been some dips. So these don't look big, but there are some dips between all-time highs. All right. There's a dip that goes pretty low here. And then here's the crazy part. It actually didn't dip that much lower. So if you're waiting for a bottom, you would have been waiting for quite a long time. And most people, they would have thought that this was the bottom, right? And then they would just like buy here. Now when it goes down, they would just sell here. So like that's how most people lose. Like you can see like this looks easy right now. Like this looks simple. Like well duh, but in the moment, and this is a long period of time, people really freak out. And I probably would freak out too. Heck, this is a long time period. So if you're buying, and all of a sudden you get a huge crash in 2008, I mean, people were doing some crazy things. As you guys know, people didn't really want to live their life no more, if you know what I mean, right? So yeah, this was a very difficult period. And then there's a huge dip here. So in this strategy, let's say you were perfect, you could have bought at the very bottom. He's about to show you some crazy, crazy data, okay? As you can see, the dip red dots occur at the lowest point between any two all-time highs. Green dots, the most prominent dip over this time period occurred in March 2009. The lone red dot before 2010, which is the lowest point after the market high in August 2000. However, you will also notice that there are many less prominent dips, right? So there's many less prominent dips, right? If we want to visualize how the buy the dip strategy works, I have plotted the amount the strategy has invested in the market and its cash balance over this time period. All right, so here you just kept deploying your cash, right? So this $100 that we were talking about before, I mean, you just kept deploying it. Whereas here, you built up a lot of cash because you kept saving $100, right? And then finally, you deployed it here, which is good. You did make a lot of money, so you did make significant money here, and you kept deploying the cash. So yeah. All right. So every time the strategy buys into the market, the red dot, the cash balance goes to zero, and the invested amount moves upward accordingly. This is most obvious when we look at March 2009, when after nearly 9 years of cash savings, 10,600 is put into the market. Okay. If we compare the portfolio value of buy the dip and dollar cost averaging, you will see that the buy the dip strategy starts outperforming around the March 2009 purchase. So here is buy the dip. All right. So buy the dip, there are periods of time where it actually outperforms. So buy the dip perfectly, by the way, this is perfectly outperforms dollar cost averaging a little bit. Isn't that interesting? Perfectly. This is like perfect. And it doesn't outperform by that much. Okay. If you want to understand why this one purchase is so important, let's consider how much each individual purchase for the dollar cost averaging strategy grows to by the end of the time period. Each black bar in the chart below represents how much a $100 purchase grew by December 2018. Okay, so for example, $100 purchase in January 1995 grew to over $500. The red dot once again. All right, so check it out. Final growth of each dollar cost averaging payment and buy the dip purchase. So obviously, like when you invest in the very beginning, compound interest has a lot. It does a lot for it. Okay, so when you're dollar cost averaging, time is such a big component. That's why, this dot here outperforms pretty much even buying in 2008. Okay, so time in the market beats timing the market. A very, very popular saying. Time in the market beats timing the market. So perfectly timing the market gets you good results if you would have timed it perfectly. You wait till 2008. Otherwise, even if you're a little bit off, you're always basically losing to all of this time. So the first multiple years beats everything. And let's be honest, no one's going to be timing the market perfectly in these scenarios, okay? So yeah, timing the market beats timing the market. The chart illustrates the power of buying the dip as every $100 invested in the March 2009. That single red dot towering near 2010 would grow to $350 by December 2018. So it did pretty good. This one purchase and its growth accounts for 52% of the final portfolio value for the buy the dip strategy. So they're telling you right here that this strategy outperforms by a bit and only because it accounted for 52% in 2008. So it really, really crushed it because in this example, there's a long wait period until this crash happened, and then you timed it perfectly. Okay. So the lesson learned here is that earlier payments on average go to more. So compounding works. Everyone talks about compound interest, but it actually works. And there are a handful of big dips. So, 2003, 2009, where some payments grow to a lot more than others. All right. So whenever the market's coming back, I always tell investors buy more. So if we put these two points together, this means that the buy the dip will outperform dollar cost averaging when big dips happen earlier in the time period. The best example of this is in the period 1928 to 1957, which contains the largest dip in US stock market history. So the final growth of each dollar cost averaging payment, all right, and buy the dip purchase. So here we can see another interesting chart. And yeah, we have obviously some big returns here. But it gets more interesting than this. So buy the dip works incredibly well over the period because it buys the biggest dip, 1932, early on, where every 100 you invested in the bottom of 1932 would have grown to $4,000. There is no other time period in U.S. market history that even comes close to this. So again, rare occurrence. I know it might sound like I'm trying to sell the buy the dip strategy, but in 1995, 2018, and 1928 to 1957 periods just happened to be two where there were prolonged severe bear markets. So yeah, obviously in bear markets, you can do well. Now coming back to options, whenever there's a bear market and things are going down, this makes more sense, not to just dollar cost average, but to sell puts into weakness. So you should be selling put options into weakness. So if we look over the longer time frames, historically, buy the dip doesn't outperform most of the time. The chart below shows the amount of outperformances from buy the dip as compared to dollar cost averaging over every 40-year period over time. Outperformance is defined as the final buy the dip portfolio value divided by the final dollar cost average portfolio value. Okay, so when buy the dip ends with more money, the dollar cost averaging, it is above the zero line. And when it ends with less money, and then the dollar cost averaging, it is below the zero line. To be precise, over 70% of the time, buy the dip underperforms dollar cost averaging. Okay, so here is the 40-year period. This is a little bit old, but studying this older data is pretty valuable because they say history repeats itself, but I truly believe that this is a constant in trading. A lot of things don't really change in trading. So buy the dip versus dollar cost averaging. All right. So here it buy the dip underperforms. So most of the time it is underperforming, especially when we're not talking about 1920s. So let's say we deleted everything below 1930. Buying the dip basically always underperforms, almost always. Okay. So what you will notice is that buy the dip does well starting in the 1920s or whatever. Kind of going to skip over this because that's what I just said. All right, so in 1975 to 2014 period, it's particularly bad for buy the dip because it misses the bottom that occurred in 1974. Starting in 1975, the next all-time high in the market doesn't occur until 1985, meaning there is no dip to buy until after 1985. Due to this unfortunate timing for buy the dip, dollar cost averaging is easily able to outperform. So yeah, here we go. Buy the dip versus dollar cost averaging. Dollar cost averaging will win from 1975 all the way to whatever they said, 2015, was it? 2014. Okay. So literally a monkey can just put $100 and keep buying the dip, or sorry, dollar cost averaging, and will beat the best, most professional investor who is not going to perfectly time it anyways. So this is why I like selling puts on a weekly and a monthly basis and just acquiring the best stock. Like, do you think so? Okay, let's go back to my portfolio. Do you think I'm worried about Apple 165 put? No. Think I'm worried about Google? No. JP Morgan, Meta, Microsoft, QQQ, SPY. Am I worried about these things going down? No, because I am just going to be dollar cost averaging and I'm using the best strategy known to man possible. Okay, so you can see this more clearly if we look at the purchase growth plot from this period. Looks like this ad is not loading, but we don't need ads. This is just ads on this guy's website. He's making money that way. So final growth of each dollar cost averaging payment and buy the dip purchase. All right, so here is a longer time period. And again, compound interest working. As you can see, unlike the 1928, the buy the dip does not get to buy large dips early. It does get to buy in 2009 dip, but it happens so late in the simulation, doesn't provide enough benefit to outperform. So unless you're in a bear market now and you're buying it now, basically unless you're in a bull market and then it's about to crash and you miss the whole crash because you can buy the dips, then this is not going to work. So usually we're not in a peak bull market and then we fall down and crash. Although people predict that, and Michael Burry and other people predict that all the time. Michael Burry has predicted about 17 of the past 2 crashes. You get the joke? He's over predicting it. All right. So if you attempt to build up cash and buy the next bottom, you will likely be worse off than if you had bought every month. Why? Because while you wait for the next dip, the market is likely to keep rising and leave you behind. All right. AKA stop waiting and start selling put options consistently. So missing the bottom by just 2 months leads to underperforming dollar cost averaging 97% of the time. So you better be perfect at timing if you're not going to listen to what I'm telling you. So even if you're somewhat decent at calling bottoms, you would still lose in the long run. So yeah, this was a so God still had the last laugh. So here he kind of expands on this. One of the most important things I relearned from all the crunching all the data numbers for this post is how dependent we are on timing luck, formerly known as sequence return risk. This is something that is completely out of our control. For example, the best 40-year period between 1920 and 1979 was from 1922 to 1961, where we were $48,000 from 40 years times 12 months times 100, and total purchases grew to over $500,000 compared to the worst period, 1942 to 1981, where your $48,000 only grew to $153,000. So this is a difference of 226%, which is much larger than any divergence we saw between the dollar cost averaging and buying the dip timing strategies. So dollar cost averaging gives you this most stable long-term result. So if you want safe, passive, consistent income, which is what I teach on my channel, and this is what I do, this is what the Discord's about, this is what all my coaching is about, you'll just stick to selling put options consistently on high quality companies, aiming for just passive cash flow. And if you get assigned, you shouldn't worry, because most of the time we start running the wheel strategy, selling covered calls, and I light this all on fire by just selling puts on margin. But there's a specific way I do it, which we've talked about. It's selling puts. Right, I can go over that later if you need, but we already discussed that part. So yeah, essentially this is like the best strategy that you can implement.